U.S. inflation data for 2026 is not what most people think. And if you invest, trade crypto, or live paycheck to paycheck, this video could save you years of mistakes. Watch till the end. The data changes everything.
U.S. inflation in 2026 is no longer just an economic statistic. It is the central force shaping American wealth, consumer behavior, global markets, and financial power. After years of aggressive Federal Reserve tightening, supply chain normalization, and post-pandemic recalibration, inflation has entered a new structural phase. This phase is not defined by crisis headlines, but by persistent pressure. Core CPI remains sticky, services inflation refuses to cool fast enough, and wage growth continues to clash with productivity. Investors who expect inflation to disappear are already behind. The 2026 outlook suggests inflation is no longer a temporary event. It is a long-term variable that must be managed, priced in, and strategically navigated. This is why institutional capital, hedge funds, and sovereign investors are adjusting portfolios, duration risk, and alternative allocations right now. Inflation expectations drive bond yields, equity multiples, housing affordability, and crypto narratives, all at the same time. Understanding this shift is not optional anymore, it is foundational. When Wall Street looks at U.S. inflation in 2026, it does not react emotionally, it reacts mathematically. The Consumer Price Index, core CPI, and PCE inflation remain the primary data points driving capital flows. Energy inflation has stabilized, but shelter, insurance, healthcare, and services remain elevated. This matters because services inflation reflects domestic demand strength, not global shocks. Core inflation above target signals that the economy is still running hotter than the Federal Reserve prefers. Bond traders price this instantly. Equity valuations compress or expand based on these prints. Even crypto volatility responds within minutes. In 2026, inflation data releases are no longer news events, they are market-moving triggers. Smart investors do not guess inflation, they track trend lines, revisions, and forward expectations embedded in Treasury yields. This is why understanding CPI composition matters more than headlines. Inflation is not one number, it is a weighted reflection of American life. The Federal Reserve's role in 2026 is no longer about emergency control. It is about credibility maintenance. Rate cuts, pauses, or prolonged restriction all send powerful signals. Inflation above target limits how fast the Fed can ease, even under political pressure. This creates a delicate balance. Cutting too soon risks reigniting inflation. Staying tight risks slowing growth. Markets in 2026 are laser-focused on real rates, not nominal headlines. If inflation stays elevated, borrowing costs remain structurally higher, reshaping mortgages, credit cards, auto loans, and corporate debt. This environment rewards discipline and punishes leverage. Investors who understand Fed reaction functions outperform those who react emotionally. Monetary policy in 2026 is no longer binary. It is conditional, data-dependent, and deeply interconnected with inflation psychology. Inflation does not kill markets. Uncontrolled inflation kills valuation clarity. In 2026, stocks are priced against real returns, not optimism. Companies with pricing power outperform. Growth stocks face multiple compression if inflation remains sticky. Dividend stocks, energy, Infrastructure and defensive sectors gain renewed relevance. Earnings matter more than narratives. Inflation reshapes consumer spending, profit margins, and capital expenditures. Investors who understand inflation positioning rotate early, before headlines change. This is how institutional money wins. U.S. equity markets in 2026 reward patience, fundamentals, and macro awareness, not hype. Crypto in 2026 exists at the intersection of inflation fear and monetary evolution. Bitcoin's narrative as digital gold strengthens when real yields fall, but weakens when inflation outpaces adoption. Inflation drives liquidity cycles, and liquidity drives crypto. The mistake retail investors make is treating crypto as isolated. It is not. It reacts to inflation data, Fed policy, and dollar strength simultaneously. Smart crypto investors watch CPI calendars as closely as blockchain metrics. In 2026, crypto volatility is not random, it is macro-driven. Inflation is not just economic, it is psychological. In 2026, Americans adjust spending habits, savings behavior, and risk tolerance based on inflation expectations. Persistent inflation creates caution, not panic. It shifts priorities from growth to protection. This behavioral shift affects markets quietly but powerfully. Understanding inflation psychology allows investors to anticipate moves before they happen. U.S. inflation controls global capital. In 2026, dollar strength, emerging markets, and commodity cycles are directly tied to U.S. inflation trends. A strong dollar pressures global liquidity. A weaker dollar fuels risk assets. Inflation data from the U.S. remains the global anchor. This is why the world watches U.S. CPI releases. Smart money in 2026 does not fear inflation. It positions around it. Data-driven decisions, diversified assets, inflation-aware strategies define winners. Inflation is no longer a shock, it is a system. Those who understand it early stay ahead permanently. If you want more information, please subscribe, like, and share this video to your loved ones.